So in today's video, we are going to have a lot of fun. We are going to look at a case study. We're going to look at a business owner who's interested in a whole life insurance policy for high cash value, but he's got some specific goals with respect to one, how to fund the policy. We're going to look at two different scenarios, but we're going to go through a lot of information that will provide additional details that are good to be aware of if you are a business owner considering a whole life insurance policy. Ever wonder, what questions should I be asking to make sure that a policy is truly set up in my best interest as the consumer, not the agents, not the insurance companies? Like, I want to make sure the policy is set up properly, because with a whole life insurance policy, it can be set up where I can copy big corporations where I hear of them doing it, or it can be set up where I've got buyer's remorse. I find out that it could be set up differently after I've already started a policy. So his specific goals are as follows. He wants a whole life insurance policy set up for maximum cash value. That's the goal. So first and foremost, maximize the cash value, but then specifically what he wants to do is use it for his business. The death benefit will provide business protection, specifically key man insurance he'll have, in addition to a couple other benefits. And then second, the cash value provides almost a line of credit for him, where he can leverage the cash value as his own personal line of credit instead of going to a bank or another source, of course, once he builds that cash value up. And what he's doing here is just moving money that's already in cash, money sitting in cash accounts, checking and savings, and moving it over to a cash value life insurance product. Because what are the core benefits to the cash value? Safe, liquid, tax-free. Tax-free if we don't trigger a taxable event, such as a MEC or a policy lapse with a gain on it. So the funding we will look at, the first scenario, I should say, is as follows. We've got $300,000 per year going into the policy for 5 years. So that's a total of $1.5 million. And I will add, initially he's got a large lump sum, about 7 figures, $1 million that he knows he can fund the policy with. After that, he would like to build in flexibility where he can continue to fund the policy if he chooses to do so, and also not being committed to a $300,000 payment every single year. So we are going to walk through the actual design of the product. We're going to touch on that briefly throughout this video, but in short, he's not committed to $300,000 per year. That's his goal. That's the target amount he wants to pay in, but his commitment is closer to $30,000 per year, and then he can add additional funds up to $300,000 without being obligated to that. So what we will review is as follows with this specific design. Number one, the guarantees. What do the guarantees look like based on the guaranteed rate with this particular product at 3%? Then, what does the present dividend rate look like? The present dividend rate, this will be a Guardian product we'll look at, is 5.65%. And then we will also look at their index rider, which is tied to the S&P 500 index. And we'll explain that in a little bit, or in detail a little bit. But in short, this is a rider that can be attached to a policy, and it is still a dividend-paying whole life insurance product where I can elect to exercise the indexed rider on some years, then some years the dividend rate. Maybe I go 50% index, 50% dividend, or I can just attach it, leave it at zero, and I've got a dividend-paying whole life insurance policy forever. What I mean when I say that, attach the indexed rider, leave it at 0%, meaning I never turn it on, and the policy functions as if I never had it in the first place. But we'll look at those assumptions as well. With all of those assumptions though, what I want to hit on here, have you ever looked at a life insurance policy and seen a dividend rate, say of 5.65%? So let me ask this question. If you had $100,000 in cash value and you were told that the company's paying you a 5.65% dividend rate, what do you think your cash value is going to grow by naturally? Well, I used to think when I was new in the industry that I would earn 5.65%, 56.50. That is not the case. And the reason why is anytime we see a dividend rate, or guaranteed rate for that matter, any rate with a life insurance product, it is always a gross rate that is applied to your policy after the company's insurance expenses, mortality charges, basically everything that comes with the life insurance product. So if you're just trying to figure out, well, what's the policy actually growing by? Like, what's the net dollar amount? What's the net rate? What we want to look at with a life insurance policy to obtain the net is our internal rate of return, which is our IRR. And we can look at both the annual internal rate of return, which isolates what the policy is growing by each year, and then also the average internal rate of return. which takes into account a certain number of years. For example, if you said, what's the average IRR over the next 20 years, the projection, or what has my policy actually done over the past 20 years or 30 years if you've had a policy for a long period of time. So that's what we'll look at first. And then we'll also look at an alternative strategy because we do run into this quite a bit where someone has money in cash and they say, okay, the 300 over 5 years looks good, but I'd like to get the money into the policy faster. I don't want it sitting in cash, in my cash accounts, checking and savings because it's not doing anything there. And I just like the idea of getting it into a policy faster. Can you do that? The answer is yes. And there's some trade-offs too when you move money into a policy faster, especially if you have no intention of making any payments after the fact. But what we're going to look at with respect to an alternative is as follows. We're going to look at the first year, $1 million paid into the product. So a one-time lump sum of $1 million. And then years 2 and 3, $250,000 paid into the policy. So you've got the same dollar amount going into the product, $1.5 million, just in a condensed time period over 3 policy years instead of 5. So you're getting the money in faster. However, in order to get it in faster, we need a larger death benefit to prevent a modified endowment contract from occurring. That's a MEC, taxable event, which we don't want in this case. But what we'll do here, what we'll review is as follows. We'll look at a different product which accommodates a design like this more, which is Guardian's 10-pay policy. The guaranteed rate on that product is lower. It's at 2%. So one trade-off you'll see here is weaker guarantees or lower guaranteed values. The dividend rate is the same, 5.65%. That's always going to be the same as long as I've got the same company. And then we'll also look at the same index rider. But what we'll look at is that dollar amount going into a policy and the net internal rate of return. What's the IRR on an annual basis? And then also what's the average internal rate of return? And as we look at these, what we're going to finish with as we go through everything is using the policy. So his goal is what? First, to maximize cash value, but then he wants to use it. So seeing specific models on how you can use that cash value as a line of credit. What does it look like when you borrow $750,000 to purchase another building or make an investment in your business, and then you can pay it back at your leisure? What's it look like if you only pay the interest? What does it look like if you pay it back in full? How much are you paying in interest in a strategy like this? Whether it's with a direct policy loan or if you're using a third-party lender, assigning the cash value as collateral to a bank, how much am I paying in interest in any of those scenarios, insurance company or bank, versus what is my actual internal rate of return? A lot of business owners and real estate investors we work with, this is so important. They ask this question all the time. What's the policy growing by? And then what am I paying in interest? Am I positive? Am I negative? Is it a wash? At what point in time does it make sense to borrow? Those questions come up. So we're going to look at a model that directly addresses that. So let's get on into it and have some fun, shall we? So what we've got here is our Excel comparison sheet, and we're going to start with the $1.5 million over 5 years, total of $300,000. We'll start with the worst case scenario, the guaranteed values. So as we look at this guy, in fact, before we look at that, when you see numbers, we see the cash values, the death benefit, all of those important columns. But if I'm you, what I'd want to know first is before I look at the cash value, if I just look at the annual payment over here in blue, this $300K per year, where's that money going? Is it set up properly? Because here's the big thing. That money can go toward the insurance premium or toward my PUA rider. PUA dollars allow me to accelerate the cash value growth. And here's the actual breakdown. Let's make this a little bit smaller. So what do we got here? We see the funding matches the Excel comparison sheet, $300K per year for 5 years. There's your total out of pocket, $1.5 million. Here's my money column, net cash value. This column represents the actual cash value that you have access to. And then the net death benefit of $6.1 million, kind of an oddball number. How we came up with that is, again, that gives us a MEC limit of just about $300,000, which tells us that's the minimum death benefit we need in order to be able to pay up to $300,000 per year. So you don't need to know all of these details. We'll make sure it's set up properly for you, or your agent will. But I'm just going through some of the mechanics here because I enjoy this stuff too much. But of that $300,000, money can be directed toward the insurance premium, which is right here, $27,000 and change, or toward your PUA, paid up additions rider, which is right here. Now, of this PUA payment, about $1,700 is carved out to accommodate the term rider that's attached to a policy. So that $6.1 million death benefit, where we came up with that, is again for that MEC limit. So I can still access the cash value without having to pay taxes on the gains. If I don't trigger MEC, I can use it tax-free. So up here, when you add these two death benefits together, you get $6.1 million. The premium is at $27,000 and change. That buys him a whole life death benefit of about $1.4 million. That would give him a MEC limit of around 60 or 70K, not $300,000. So what we did in this case was add additional life insurance, term insurance, and what this is a cheap way, I don't like the word cheap, cost-effective way to add more life insurance to the policy, which gets our MEC limit where we need it, so we can use the policy with the favorable tax advantages. Interesting stuff, right? So, as we look at this guy, this is based on the present dividend rate. We can look at this same illustration, and we can obtain the guarantees right here. Anytime you see any kind of simplified spreadsheet, we do want to make sure we have the illustration as well with the guarantees and all assumptions. So right here, under guaranteed, there's my guaranteed values. You paid in $150 or $1.5 million. Break-even point between years 8 and 9. Year 9, you've got more than the $1.5 million you've paid in, and that's based on the guarantees. Worst case scenario. What he's committed to. So I want to hit on the flexibility before we look at the Excel chart. If this is you, what you're committed to is the base premium plus the term rider. A lot of people we work with will typically commit just to those two and then round up. So if we wanted to round here, call it $30,000 per year. That's my minimum commitment. And then all of the additional PUA payments, instead of paying them on a scheduled basis, which means you would be billed for the PUA payment the same time you make the base premium payment, you would do it on an unscheduled basis. Meaning you add the additional PUAs at your discretion, and you don't have to hit the $300K per year either. If you don't, it'll perform a little bit lower than what we see here, and that is something we want to track over time. So with that said, instead of going back and forth with different Excel sheets, instead of different illustrations, let's take a look at the side-by-side. So here we've got the guaranteed values from the illustration we just looked at, $300K per year. Total payments, $1.5 million. What's highlighted in yellow represents the break-even point. Here we go, between years 8 and 9. First year cash value, $250,000. Just about a $50,000 hit. And when I look at the internal rate of return, negative 16.31%. So annual IRR, again, is isolating the policy growth each year. If it's in the red, I've gotten back less than what I paid in. If it's in the black, the policy has a positive growth rate. But this isolates the annual growth each year. So here we go. Gross rate, 3%. Do we ever see it produce 3%? No. On an annual basis, tops out at about 2.57%. Now, this is absolute worst case scenario. And again, assuming we don't trigger a taxable event, we can access that tax-free pretty easily, which is nice. So that is attractive to some people. Then you've got the average internal rate of return. If I look at my average by age 65, about 1.79%. Again, worst case scenario, is it likely? No. We've always seen these products do better when they're well designed with the major mutual carriers. However, in an effort to be fully transparent and full disclosure, it's important to look at the guarantees to really see if we look at that and think, you know what, I'm just not comfortable with it. This is not for me. After seeing the guarantees, that's okay. But I want to see that up front. If it's me and I'm new to everything, I do want to be shown this at the very least. Let's continue on and take a look at the dividends here. So here's the present dividend rate at 5.65%. which this is the third consecutive year Guardian has paid a 5.65% dividend rate. And again, that 5.65 is a gross rate, not a net rate. So exact same policy here, just the present dividend rate. Break-even point in this example, year 5. Same death benefit because it's the same product. IRR, first year, again, that same 250. Second year, let me back up. We pay in $300K, grows from 251 to 546, which means we've actually lost about $5,000, a little bit less than that, 4,200 and change. But that's why we have a loss of 0.77% in the second year. I paid in 300, I did not get the full 300 back. If I got a clean 300K back, meaning if I got the money back that I paid in, then that annual IRR would be 0.00. Now, the next year, year 3, we pay in 300, grows from 546 to 851. So you got your 300 back, a little bit more on top of it. That's why I've got a positive internal rate of return of 0.57%. Gets stronger each year. You'll typically see this with a whole life insurance policy. It'll continue to pick up the pace. Then we stop making payments. Year 6, we can continue to pay, but his goal was to get 1.5 in. He got into the policy, and you see a big jump on the internal rate of return, almost 2 full percentage points. The reason why is because if I'm not paying anything toward the policy, there's no premium loads. Every time I pay a base premium, there are loads or additional expenses that come with it no matter what. There are expenses for the term insurance rider. There's fees on PUA payments. There's everything that comes with the life insurance policy, additional costs. Now the goal is to minimize those costs. However, when I'm paying them, the IRR reflects the net growth rate factoring in all of those costs. Once I stop paying, I'm not paying those fees, so the IRR takes a little jump. If a policy is designed with a higher base premium, you will not always see it take a nice jump there. It's got to be properly funded quite aggressively in order for this to actually work. Then, next year, jumps up a little bit more, but then it jumps even more. Look at this. What's going on here? 4.35 to 4.76% on the internal rate of return. A lot of times people question this, like, why is the policy taking these jumps? I mean, I'm not complaining about them, but what's going on here? Like, it tops out at a little over 4.75%. The reason why, going back to the detailed ledger, the reason why, after year 5, what happens here? Your out-of-pocket is 0. Look at years 6 and 7. Your out-of-pocket is 0. You're not paying anything in. However, this base premium of $27,000 and change is still due. The policy is covering this premium internally. We exercised a premium offset here, which allows the dividends and interest to pay the premium for us. Then everything left over is kicked back into cash value. So it performs nicely in this example. It's also covering the cost of the term rider. But then what happens? Year 8, we exercised that. Reduced paid up, RPU. What this does is eliminate the premium altogether. It also eliminates the term rider. As a result, the death benefit drops. That's one drawback. Another drawback is that I cannot pay anything else into the policy. So if I'm sure I don't want to pay anything into the policy, this is a good option. However, we want to look at it and make sure that that's certain. But when that time comes, once we exercise it, no more payments are due, I can continue to access the cash value all day long, which is nice. Borrow and repay, borrow and repay. However, I cannot add anything. But when we hit that kill switch, that reduced paid up option, because we're eliminating the term, because we're eliminating the premium that we're not paying, we're almost removing the drag, that's how I like to refer to it, and it allows the policy to grow at a faster rate. This is especially true when you look at the guarantees. You can actually see that over here, where it continues to grow. If we just run a premium offset forever based on the guarantees, a lot of times you'll see that internal rate of return gradually trickle down. Not all the time, it depends how we funded the policy, but very often we'll see it go down over time. So we like to make sure that based on the guarantees, everything's buttoned up to be as strong as we can get it. Let's take a look at the indexed rider values. It's a good option to attach to a policy. You know, how I like to explain it, if someone's interested in it, is it does grant you a little bit greater earning potential, but most people we work with will attach it at 0%. They don't use it for the first several years, and they intend to use it in the event of a large market correction. They say, hey, I think that the market's going to rebound, and I think as a result, if I go with the index strategy, my policy cash values will perform a little bit stronger than what I would receive with the dividend. So let me go 100% index, or let me go 50% index. We can actually choose what percentage of cash value we'd like to tie to the index, and then what percentage of our cash value we'd like to tie to the dividend rate. However, when we turn it on, there is a fee. Currently it's 2%. It has a maximum fee of 3% that is assessed to the percentage of cash value that is linked to the index strategy only for the years that that indexed rider is exercised. The cash values we see up here do reflect that fee. It assumes it's being charged each year, so these are the net values, but there are some things I want to be aware of. We do have a video, I've got a couple of them, but the video up here does provide a full breakdown on the indexed rider and answers a lot of commonly asked questions. But it's a good option, and what's attractive about it is this looks at the past 20 to 25 years of the S&P 500 history, and there's the performance there. So it does give you greater earning potential. However, this is all hypothetical. I'm not a fan of saying based on the market history, if we just repeat the past 20 to 25 years, this is what your policy will do. It's like, not quite, because there are things that can be adjusted with that indexed rider as far as the cap, the fee. It's currently 2%. It can be raised to 3%. There's some moving parts there, which we track over time, but there's a bit more to it. And again, that video provides a full breakdown. So, current plan. 300K over 5 years. That's what it looks like. And again, the goal is to maximize cash value here. Now, let's look at the alternate strategy, and then we'll look at using the policy via the line of credit feature. That's his plan with the cash value. But first, let's take a look at the alternate here. This will be pretty cool. So what we're going to look at here is 1.5 million over 3 years. Let's do the same thing, and we'll start with the worst case scenario, being the guarantees. So what do you notice here? Product has a guaranteed rate of 2%. We use the 10-pay policy because it does give a bit more potential from a long-term performance standpoint. And look at that. If we do things right, look at that first year cash value. Paying $1 million, I've got $890,000. So it's just about an 11% hit. Do you remember what the 300K per year product was? About a 16% hit. And again, that's due to the PUA fees. We will see some adjustments to that in the near future, which will be nice. But looking at this, so let's start again. This is a worst case scenario. Getting the money in faster. So as we look at this guy, what do we notice here? Where's your money going? A little bit different breakdown with the 10-pay product. Not a whole lot of people we work with go with the Guardian 10-pay policy, usually because they want to fund it for more than just a couple years. You'll see where I'm going with this. Here's your total outlay based on the guarantees. $1 million the first year, $250 years 2 and 3. That $41,000 premium and change. Where we came up with that dollar figure is Guardian will allow us to illustrate whatever the base premium is, an additional 5 times that per year in PUAs, with the exception of the first year, where I can illustrate 50 times the base premium. So what we did here was just really work within the rules of the game, the boundaries we have here, in order to reduce the base premium based on the future payments. You wanted to pay in $250 through year 3. You can make a large one-time lump sum. There's an extra $750 in PUAs for a total outlay of $1 million. There's my $890. Death benefits high. $14.45 million. Where did we come up with that dollar figure? You probably know. MEC limit. We wanted to solve for a MEC limit of guess what? $1 million. Now, this could be hard to qualify for based on your income. We do want to look at the income guidelines and how much a life insurance company will actually approve us for in death benefit. We do have a video up here that provides a breakdown of those guidelines and exactly how it works. So there's the guarantees. You can look at the same thing here with the non-guarantees based on the present dividend rate. And there we go. Click smaller. There's your premium. PUA, 2 of them there. All the same thing. Why we've got that big unscheduled PUA payment, that's just the initial extra $750,000 going into the policy. But the term riders we've got 2 of them attached. We had to be creative with this design. And then here's why the guarantees do not look as attractive. The 5-year funding example, we paid into it for 5 years. There are 2 years where that $27,000 and change premium was due, but you did not pay it. The policy was paying for itself. Do you remember that? It was 2 years. And then year 8, we looked at that reduced paid up option. So here, what's going on? Net after tax outlay, $1 million in the first year, $250, 2 and 3, and then 4, 5, 6, 7, 0 out of pocket. The policy is paying for a premium of $41,000 and change for 7 years. It's also paying for the term rider cost over here. This is the 1-year term rider. And then also an additional $7.35 million in term insurance. So we've got some expenses on this policy. Now, based on the present dividend rate, even a conservative dividend rate, when I'm stuffing this much money into it, it covers those expenses without even trying. It's almost effortless. When I look at it here, cash value continues to appreciate. We're almost positive year 4 in this example. I'm sorry, yeah, year 4, where I've paid in a total of 1.5 over the first 3. I've got 1,497. The dividend comes down a bit. Realistically, it'll be year 5. But I am confident with Guardian, just based on the track record they've shown over the years, they've always delivered strong internal rates of return on cash value. When we've looked at them over the past 6 years, their dividend rate's been at 5.65% the past 3 years, the 3 years prior, 5.85. And when we look at the original illustrations compared to the actual performance, they've been almost spot on, which is fantastic when we see policies produce as what was illustrated. It's been a little bit different, but they've been performing very strong. And that's a big reason I'm so big into the major mutuals and properly designed policies. We want that actual performance to be strong. However, all of that is meant to say that I can expect it to do better than the guarantees, most likely, but I still want to take into account what the guarantees look like. Anyway, why the guarantees did not look attractive is because of that drag on the policy. The base premium and term rider costs were exceeding the interest earned, that 2% guaranteed rate. So let's go back. There's the guarantees. What do you notice here actually? Look at your annual internal rate of return. It's in the red until when? Year 8. What happens at year 8? The death benefit drops. We killed the premium with the reduced paid up option. That's why it starts to go up, because I'm not doing anything different with respect to payments. Dividends, much different story. So here we go. Positive year 5. I should have highlighted between 4 and 5 because I'm just about there year 4. But check that out. Year 1, negative hit, still $110K. I mean, it's better than the other options, but it's still $110,000. Year 2, however, I get my $250 back and a lot more on top of it. Year 3, IRR is 2.27%, starts to pick up the pace. Look after the reduced paid up, another jump. And this is based on the present dividend rate. It is something we do want to track year over year. But for a safe area to position money where I can leverage this like a personal line of credit can be attractive. And it is a matter of preference between this and the first strategy we looked at. The first strategy is a little more conservative, the $300K per year for 5 years, but it's also safer because it's more conservative, particularly when we look at the guarantees. If we look at the index, well, yeah, that's going to look quite attractive. Right, tops out a little over 6%. That lump sum up front, man, that can do a lot of good. So let's take a look at the loan strategy here. This will be fun. So we took the dividend rate example with the $1 million lump sum, since a lot of business owners are attracted to this, and investors for that matter, real estate investors that are using the policy as a place to position funds. So here we go, million in, 890 in cash value. We've got our loan workbook to the right. We'll often model direct policy loans through the insurance company software as well. This simulates a cash value collateral loan, which involves taking your policy to a third-party lender, assigning the cash value to them as collateral, and then you get a line of credit from them based on your cash value. Typically, you'll see about 95% of whatever you have in cash value as your loan to value ratio. So that's why in the first year, I've got $890,000, and the maximum loan here, $846,000. I did not take any loans in the first year in this example. That's why my available equity matches the LTV at 95%. So if we take a look at this guy, let's say year 4, let's say year 5, you want to take out a loan. What happens? Policy loan comes out. Here we just plugged in 5%. Let's plug in $1 million. So at 5%, what do we have here? $50,000 in interest due. Here we've got the interest payment. So annual interest in red, interest purple, that's your out of pocket that you're actually paying to the lender, or if this was a direct loan through the insurance company, it'd be similar there. There's the $1 million loan. 5%, I want to walk through something here. Year 5 over here, annual internal rate of return, 3.71%. So if you look at the percentages, what happens in this particular example? You're earning 3.71 and you're paying 5%. Some view that as a cost of about 1.3%. However, what some also like to look at, remember we want to take into account that your cash value that you're earning that 3.71% on the full 1.5 and paying the 5 only on the $1 million balance. So what I like to look at, it's a bit more simple or simplified. What's my cash value growth here? $55,000 in change, and what did I pay? $50,000 in this particular case. So I'm positive when I look at the actual dollar amounts. Now, if I increase the loan amount, it's a different story. What happened if you increase the loan to $1.3 million? Well, now all of a sudden the interest you pay is $65,000 when you've gained $55,000 that year. I see the cash value growth. This is the annual cash value growth here, continue to increase. So let's leave it at 1.3. Let's assume that this individual pays interest only for 2 years, 24 months, and then begins to attack the loan principal balance. And he does not have any payments here. So many people love the idea of being able to use this just as a high yield savings asset and leverage it for their business when they're not obligated to make any more payments. And some do continue to pay. Again, a matter of preference. So what shall we pay it at? Let's do $100K per year toward the principal. You can do whatever he wants. So make it nice and easy. There we go. So what we've got here is as follows. Year 5, LTV was 1,475. You borrowed out 1.3. That's why available equity, you can take additional loans of $175,000. Loan balance, $1.3 million. At 5%, interest is $65,000. You paid interest of $65,000. Total interest will tally up all of the interest payments you've made to the lender in this particular example over the life of the outstanding loan. So I'll go through that at the end. So as we continue to look at this, next year, cash value grew. So your available equity here has increased to $234,000 while you still have the $1.3 million loan outstanding. Interest rate of 5%, $65,000, you paid it again. Now the next year, year 7, cash value grew again. Available equity increased, but you paid $60,000 in interest plus $100,000 toward the principal. So your true out-of-pocket would be $160,000 because we're paying what's in purple and also what's in light blue. That is your out-of-pocket that dollars you're applying toward the loan. So as we look at this, let's go all the way down to when the loan's cleared. What do you notice here? LTV and available equity is restored. There's your annual cash value growth. This column, cash value gain, represents the total gain over time. So you're at 1.47 million. What that means is you've paid in 1.5. It's 2.974. And if we take 2.974, minus your total payments of 1.5, that's the total dollar amount, the total gain, and that's over 19 years in this example. But there's my gain. How much did I pay in interest? $520,000. That's what I've paid to the institution. Now, of course, if this rate is variable, that's going to adjust over time, year over year. So we could end up paying more, could end up paying less, but we can change that year over year too. Or if we actually have a loan outstanding, we can adjust it each year. It's pretty simple in that respect. But then this way, if you're a business owner, you can actually somewhat play with the models here just to get a quick snapshot of what things would look like. These do not assume exact numbers. These are all based on a full year, whereas if you actually have a line of credit outstanding, if you're applying funds toward the principal over the course of the year, you're going to save yourself some interest there. But again, this is just a quick on-the-fly example so we can see, hey, what would it actually look like here? Just so I can get a quick idea of, does this make sense or does this not make sense based on the rate, based on the interest paid compared to the interest earned, and it just provides transparency, which we like transparency quite a bit. So I hope you enjoyed this video. I enjoyed this case study quite a bit, just because it's something that we do deal with on a frequent basis. The numbers do vary. Everyone's situation is different, but it, one, provides options on how to maximize the cash value, also the flexibility, because he's not committed to those big dollar amounts, he's only committed to a small amount, and then shows one how to use the policy for business when the death benefit does provide value here, as I've got business protection, but then two, I can leverage the cash value as a line of credit. It's my own source of financing when opportunities come up, and it's constantly compounding, continues to appreciate even when I borrow against it. That's what a lot of business owners are attracted to. And then it's really just looking at, do I want to fund it with a conservative route, $300K per year for 5 years, or do I want to go aggressive with that large lump sum? I've got a lot more earning potential there. The guarantees are not quite as attractive with that product, but just seeing the different options and picking the one that you're most comfortable with. So I hope you enjoyed it. If you did, please hit the like button and subscribe for more, and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.